All right, will do. Appreciate your help. Yep, you too. Hey, Justin. Hey, Diana.
Hello, how are you?
How are you? Good. How are you doing?
I'm doing well, thanks.
Did have a few people, at least a few more people, say they were going to attend this, so maybe I'll give it another minute. No, it's almost 5 after, so I might as well get going. I know they're recording this too. So, but one good thing the market is showing some optimism. So, um, it's looking like it's pretty close to a deal with Iran. So we'll see. I mean, time will tell if that's going to happen or not. But I think if it does, it's really going to help the market, and we will start seeing rates retreat a little bit. Um, another thing too, I'm not sure if you guys were aware or not, but Fannie Mae last month, I think it was beginning of last month, they got rid of their 620 credit score requirement. So basically, if somebody gets an approved eligible, it doesn't matter what their credit score is.
Oh,
I,
wow.
I actually closed one this month that was conventional, and it went through our same day mortgage and stuff. You know, it was a super quick deal, and the guy had a 568 credit score. I mean, he did 30% down, but the credit wasn't very strong. So something to keep in mind if somebody's got a big, if they've got money to work with, their credit score won't be as much of a factor as it used to be.
That's good to hear.
And used to be you always had to go FHA. If it was under 620, or sometimes you could get an approval like between 600 and 620 with Freddie, but now obviously it's I had one that I tried. It was 540 something that had a big chunk down, but that one I didn't like. But I did get the 568 through.
So at the 568, what is the minimum down payment with a credit score of 568?
It depends what the underwriting system likes. If the ratios are low, it'll allow the credit score to go lower. It'll kind of override the credit score requirement.
Okay.
Hey, another thing too that I've seen help me. I mean, and this is aside from bridge loans, but with FHA loans, if they can't meet the requirements to do a manual underwrite, if AUS won't take it on a 30-year or 25-year term, and it's because it doesn't like the credit. I've had multiple people just even in the last 6 months where I was able to get them approved on a 20-year fix. And that's something you might be able to use if you guys have an FHA deal that goes south. Sometimes you'll be mid-process and something comes in and it causes the system not to like it anymore. Tell the loan officer to try a 20-year fixed, because it might save the deal if it's credit related.
Okay. Well, that's good to know.
Yeah, it's almost like it just overlooks, weaknesses in the credit profile, switching to that shorter term.
Okay.
Doesn't make much sense because the payment's higher, but it works. Okay, getting into the bridge stuff. I see Robin just joined us too. Hi, Robin. Okay, one thing that I've always been doing, and this is something that's typically always an option with clients that do qualify for 2 payments. If they can come up with 5% down, they can always do it that way. If they qualify, and then once their house sells, they can come back and do a recast and reset up their payment just like their house sold first. And a lot of times that works for people, and that is the most cost-effective way to go. And we pretty much are servicing all our conventional loans right now, so people aren't going to have a problem doing a recast if that's what they end up wanting to do. Okay, so getting into some of the bridge products, we do have one regular bridge where we can go up to a loan amount of $300,000, and it's up to 85% loan to value. It would pay off any liens that are on the property, like if they had a first and second mortgage, and then whatever's left over is, and they also take out 6 months interest, so they don't have any payments that they have to make on the bridge. And then the whatever's left over, they can use for the down payment on the home they're buying. Now, Fannie and Freddie, the conventional agencies don't allow not counting the payment on the departing resident, so they would have to get hit for a payment for whatever the interest is on the bridge, even though 6 months are getting taken out. However, we do have a non-QM investor that the rate might be a little higher, but not much. I mean, probably like 0.25% or something. And they don't count that payment on the departing resident. So we wouldn't have to count the interest on the bridge or their property taxes and insurance for qualifying. So that's kind of the true bridge loan that back in the old days before the crash, they did allow bridge loans, but ever since then the options have been kind of scattered, but they're really coming. There's a lot of different options coming back to the market now, and there's a lot of appetite in the secondary market for HELOCs and things like that. So that's what's one of the things that's creating all these new options that we have now. Now, the first one that I've actually used quite a few times, people would have to qualify, for having two payments. But we have a HELOC product that we can do as a bridge, and pretty much I can plug someone's information in. I don't even need their social security number. AI these days is crazy, and we're probably going to see more and more of this. But I can plug in their info, it'll pull a value, and it'll tell me how much they qualify for. And there's different options. We know it could get paid off, in a few weeks or a month. We don't really care about that. There's whatever amount they take. This would typically go into second position unless they don't have a mortgage. They take a 3.99% origination fee. It just gets financed. They don't have to come up with any money out of pocket. And as long as it's not in a trust or something like that, we literally can close these in 2 days. And they actually close with an online notary. Everything's electronically. They kind of hop into a room, kind of like a Zoom call, and sign all their documents. And then if they live in the property, there's a rescission period. And we can also use this on investment properties as well. People could actually pull some of the equity out of an investment property they have, use it on a down payment, use it as a down payment for either a home they want to live in or to buy another investment property or something like that. Now, the regular HELOC for primary residences, we can go up to 85%. So to keep the math simple, say it was a $100,000 loan or $100,000 value of the property, 85,000 would be 85%. We would subtract what they owe. So say they owed 60, they could get 25,000 that they could use for a down payment. And that one's real fast and easy, and in a lot of cases it works. They do have to start making payments on that after, depending on when they close, it's at least 30 days. If it ends up dispersing earlier in the month, it could be up to 60 days. But the payments aren't that much on those. They're pretty much just, they can be interest only. It can be a fixed rate. It can be a variable rate. They get to choose all the options while they're in the portal. And what I do is just plug the information in. I go over it with them on a phone. I send them a link, and they just complete the process. If they run into any hangups on everything, got a customer service team that they call. The number's right there on the screen. They can go in and see what they're doing and help walk them through any of the steps. And all this can be done, at least knowing their options, with just a soft credit pull too, so it doesn't impact anyone to see what their options are. And as long as the income is input correctly, it's a solid deal. Like they've already got an appraised value they're using and all that stuff. So that one works pretty good. The only thing we can't do with that one is pay off debts to qualify or pay off other debts. Now we do have our own HELOC that we do in-house, and that one's the same thing. Oh, the previous one too, we can go to a 640 credit score on. Our in-house one, it's a minimum credit score of 660. And that one also, we go to 85% loan to value. It may need an appraisal, it may not. It just kind of depends, how the automated value system comes in. Or sometimes it just needs like a desktop or something where an appraiser doesn't need to actually go out to the property. And that one we can go to 85%, just like the other one. We can pay it. It has to be either first or second position. So if they don't have a mortgage, it would go in first position. If they do have a second mortgage, that mortgage would, if they have like a HELOC, that would get paid off and closed. We can pay off other debts and stuff with that in order for them to qualify for their main loan. And then there's not really set guidelines. The guidelines are based on whatever the main loan is that we're doing. So for example, if we were doing a DSCR loan, I don't know if everyone's familiar with those, but they're gaining popularity with investors. But we would follow the same DSCR criteria to do that bridge, and it could be on their personal residence or it could be on another investment property. And that one they don't have to make payments on. The interest just accrues for whatever amount they take out for so much a day. And it's initially set up for 120 days, but that can get extended if somebody hasn't sold their house yet or something like that. Now with in that case I mentioned with DSCR, this bridge is meant for properties that are going to be sold, so either under contract or something like that. So they would have to sell the house if they use that property. That first one that I talked about, it is set up to be a bridge, but they actually could keep it as long as they wanted. They wouldn't necessarily have to sell the property. Okay. Any questions so far? No. Okay. Okay. The next series of products we call it our cash ready loans, and these are all bridge type products. Basically, have an affiliate that'll either buy the house, or they have some other ways where they can do like a signature loan, which I'll kind of go through the details. If they buy the house on the client's behalf, basically there's just an addendum that goes along with the purchase contract. And what I've done before using this, if the agent isn't familiar with how everything works, is usually we get on a conference call with the rep and you and the client, and they can kind of explain the process, and then we'll get all the paperwork and stuff out to them. But I only need about 24 hours to get somebody pre-certified for all their different product options. So the first one, and when it first came out, this was the only product they had, but they'll actually, they have to look in to the details on the house that people are going to be selling. And it's very helpful if it's already in the MLS, so they can see all the data about the house and the recent pictures and that sort of thing. And that does kind of come into play because they do want that other house to get sold, ideally within 90 days. But then again, if somebody needs more time, they can get that extended. And they do want, like, as part of the approval process, they don't hold people to this, but they want the agent to come up with a plan of a pricing strategy plan, like where they're going to list it at. If they haven't got any offers after such a period of time, they're going to drop the price to this, and kind of out through a 90-day period, just to kind of get the seller to be open to lowering the price if they need to sell the house, if that makes sense. The cost of doing that is 1.9% of whatever the amount of the new purchase price is, because in that case, the company's just basically fronting that money. So the bars need to be able to pay that 1.9% origination fee up front. That's the only upfront costs they have, and those can close fast. They also have a rescue product. The fee's a little bit higher on that. It's 2.1%, but I've used this before to rescue deals from other lenders that were falling apart because it was accepted on a contingency, and then their contract on the house they were selling fell apart for some reason. We can use this to hop in and get the house bought so they don't lose the house, and then they have the time to sell the house. And then depending on the amount, it's kind of like a daily interest. They come up with a per diem carrying cost, and that just accrues to where once the house sells, they get invoiced for whatever it is. It's almost like paying rent for while they're occupying the property. They do get immediate possession. And again, those can be closed in as little as a week. They like to have at least 10 days, but it can be done as quick as a week. They also have, and in that case, it would be titled in the affiliate's name, which is the name of the company, Zavvy. And then the client would come back through us and do their loan once they received an offer on their house, and they basically just pay Zavvy off. They also have a signature product where if someone has 5% down, and in some cases they'll go as low as 1% down, they basically pay that up front, and they actually would take title of the property at closing. And then it's what they call a cross collateralized product. And what they do is put the lien for the personal note that the buyers sign that they'll pay them back for what they paid for the property. They put a temporary lien on the house that they're going to be selling. And that one's just kind of nice because the people take title right when they close and take possession. So there are a number of different ways to go about that, and they are pretty easy to work with, and they're we can get answers pretty fast for them. I haven't taken a scenario to them where I didn't have the options on what they could do in less than in more than 24 hours from the time that I sent them all the info. And they don't need a ton of info either. Basically, they just need my findings that I ran everything through if they sold the house and they qualify for the loan. And then, they review the details on the home that they're going to be selling. So they're comfortable that it's going to sell at a price high enough to, that they'll be able to get out of it. Because they don't really like to be in these more than 90 days. It does happen sometimes, but they really start getting on them to get more aggressive about the price if they haven't sold yet, after 90 days. So with that, those are the ones that we do use most often. If something doesn't fit like inside that box, I've got a slew of products that we can broker, and one will go as low as a 600 credit score on the bridge financing, and they'll still go up to 80% loan to value. And that particular broker will even do them if somebody's got like a non-warrantable condo. Co-ops aren't very popular in our market, but unique properties, like properties that have acreage or ones that are hobby farms or something that are like too big for standard financing, they will consider stuff on unique properties like that. I think even log cabins. So we do have that. And then got a number of ones that if people need non-conventional type financing, like say they're self-employed and they don't show enough money to qualify through Fannie or Freddie, they could be qualified using a bank statement loan, or they have one that is a full doc loan, but it's a high ratio. Fannie and Freddie won't go higher than 50% debt ratio. It's pretty much an automatic decline. With Freddie rounds down, so sometimes it'll still approve people if it's like 50.4, but if it hits 50.5 or higher, there's no way that they're going to get regular conventional financing without putting more money down in order to get the debt ratio down below there. We're paying off other debts or something like that. We do have one that'll go to 55%. And sometimes that can make a big difference. I mean, 5% doesn't sound like a lot, but, the difference, like FHA, we can get some approved up to 56.9. Sometimes that's 40, 50, 60, $70,000 difference in price, just that extra 5%. So that can be used in some cases where the debt ratio is a little tight. And then we have different ones that'll go higher, as far as into the millions. We have a couple. I don't know. I know we don't have many jumbos here in our market, but we do have ones that'll do bridge loans up to $5 million. So you run into that unique one, there might be an outlet for it. That's most of. Make sure I didn't miss anything with my notes here. That pretty much goes over all the options, other than if I got into all the different options with like the brokered products. Let's see, there's 1, 2, 3, 4, 5, 6, 7, 8, 9 different ones that kind of have their own bridge programs that fall outside of the ones that I can do in house there. So it's always worth looking at something. The biggest thing in order to even consider a bridge is somebody does need to have a substantial amount of equity for that to be a viable option for them. And yeah, they do. We do have a 12-month option. They can get extensions, but say in the case somebody's building, we do have the brokered outlets where they can do 12 months bridges, and they can take 12 months worth of interest out, so there's no payments on it either. So that's a good question. Those options there's not as many if they need 12 months. But again, even on the other ones, they're set to be for a certain period of time. But if people do end up needing more time, it's like pretty much everyone's hands are a little bit tied there, to waiting for the property to sell. So they're usually able to kind of work with people if they need more time to get the home sold. And I don't, as far as the market too, I know what I see on my end doesn't always represent the entire market, but I know like this year it's been a little busier than the past several in the spring market, but literally the last 4 years in a row, at least for me, the busiest time of the year by far has been the summertime, from like the second week of June until even the first week of September. I know school's starting up and stuff in August. That kind of slows one segment of the market down. But everyone thinks the spring market's always the busiest. I know the last 4 years in a row, and it's been like a noticeable difference for me. The summer's been the busiest time of the year. So I think we have potential if they can get the price of oil stabilized, for rates to come down a little bit. And I think that would really help spur the market. I just saw something I forgot. That cash ready program. And I know we don't have many markets that are super competitive around here right now. I mean, some are, but if you look back to like times during COVID, when have an open house and 35 people would come in, you could get 10 offers and that sort of thing. I think if the rates come down enough, there's potential to see market activity like that again. And I know cash is king as far as cash offers go, and those multiple offer situations. And if that does come back, that cash ready program that we have, people can use that. Like if they're sick of losing out to cash offers. And I actually did a couple of these in the Columbus area. I mean, some of those properties in Columbus, when the market got so hot, I mean, they were coming in with $50,000 non-refundable earnest money, waiving the appraisal, waiving inspections, just crazy offers to get their offer accepted. but someone can use that cash ready product just so they can make a cash offer on a house, so they can come in stronger and then decide what they want to do with the contingencies. And again, that's not so prevalent now, but rates come down, 0.5%, 0.75%. You get that press and stuff. I do think there's still a lot of people waiting on the sidelines right now to hop in and buy something when the time's right. So something to keep in mind if we run into that in the next few months or later in the year or next year, whenever it happens. I do think it's going to happen at some point, but all right. Anyone else have any questions or anything? No, appreciate your time today. If you ever have any questions, shoot me an email or give me a call. I'll be happy to help out any way I can. Hopefully you guys have a great weekend. Finally getting some good weather. So I know my yard needs some serious help. So I'll be out there some this weekend. But other than that, we'll call it a meeting. And you guys have a good rest of the day.